Back with First Trades right here on 18 Let me now welcome on board Rahul El Kanodia, the Vice Chairman and CEO at Datamatics, to talk about how their performance has been. Mr. Kanodia, great to have you today on 18 Thank you so much for your time. Just looking at your top line growth of about almost 10%. On a year-on-year basis, but sequential, it's been little flattish and has a mild 1% kind of dip. Tell me, how does this track your high single-digit FY27 guidance and whether it still looks achievable?
No, it does look achievable. We will stay with that guidance. If you look at our pattern in Datamatics, we always have a high Q4 and a slight dip in Q1. If you look at the last 4 years, you'll see that pattern because we have some cyclicality in the business in Q4. So this is a very normal pattern in Datamatics. So I'm still confident that we will hit our guidance.
Mr. Kanodia, margins also on a year-to-year basis looks good, but on a quarter-to-quarter basis, there's a dip which is there. And you spoke about the seasonality also coming into play. What would be the normalized margin that you see for FY27?
I think we will maintain this. In fact, we'll improve it slightly, another 0.5% to 1% improvement in margins. So I don't see that to be an issue at all.
Around 20-21%?
We were at about 19, if I'm not mistaken, last year. I think we'll be in that same range.
I was looking at your PAT margins as well, because there too there's been a significant jump. Tell me how much of this is structural from AI-driven efficiencies versus maybe one-offs?
They're not one-offs, but the AI-driven efficiency is still to kick in completely. These are more just operational efficiencies and general performance improvement. But the AI components are kicking in. So a lot of our newer deals that we are winning, most of them, in fact, majority of them are AI-driven, but they're just starting. So we won the deals, but they're just starting. So we still need to get the financial benefits of these new deals that we've signed. So I think that will come in. But right now, these are more operational efficiency-driven margin improvement.
You did credit AI-first strategy for larger, higher value deals. Tell me what share of Q1 revenue or pipeline came from AI and agentic solutions?
So actually, right now, if you look at the new deals we've signed in this year, roughly 60% of the new deals are AI-driven, largely AI-driven. There's AI in everything, but some of them have a very peripheral component of AI, and some of them are largely AI. So I would say 60% of the newer deals are largely AI-driven, which is very good. That means that it shows you a shift in the market. The POCs that we were doing are still there, but these are now live projects that are coming in.
Interestingly, as you said, 60% of the new deals are coming through AI. What is the kind of transition that's happening to your balance sheet as well from a cash flow point of view? What kind of working capital changes that comes in? What is the kind of receivable days which are there or DSO days which is there? Are you seeing some changes because of the kind of structural shift which is coming in the way the orders are coming in or the new deals are coming in?
Yeah, so the DSO is, in fact, we marginally improved from 63 days to 60 days. So DSO has marginally improved, but no major change on structure. So I think right now, from a working capital point of view, it's business as usual. So we don't see any major shift. Our investments continue the way they are, and we will continue doing the investments. So no major shift in the working capital yet, because it's instead of labor, we are using tokens. From a cash flow point of view, it's pretty much the same.
So you're saying that, the labor arbitrage which was there when you're getting in AI is getting offset by the cost of tokens now?
Not fully, approximately. As I said, these are new deals that we won. The projects are just starting, so it will take some time to stabilize. The challenge with the tokens is that every time they launch a new model, the prices are higher. Whereas with labor, at least you have a steady price for a year. You've got fixed salaries. But in tokens, every new model becomes more expensive, and therefore we have to constantly optimize between newer models and the older models, and therefore look at how the accuracy, throughput, all of that. So right now, since these projects are just starting, I don't think I would be in a position to really comment whether it's made a material impact on cost structures. But suffice to say that, it's looking very promising.
So, from your point of view, your efficiencies will increase because of lower manpower, which is getting in, and you are able to bring in those models. But from a client point of view, their cost of general services would go up because of the increase in token prices. Is that the way to
Um,
understand?
No, that's not correct. So labor cost is coming down. So as far as the client is concerned, in fact, there is a pricing pressure that we see because clients expect that because you're using AI, it'll be cheaper. So there's a lot of tough negotiation going on because they expect the prices to drop using AI. So right now, what's happening is that the token utilization is fundamentally cheaper, but we have to be sort of sensitive to the different models and the accuracy and the throughput. The advantage to the client is basically the throughput increases, turnaround time reduces, accuracy improves. So that's the net benefit to the client. On the cost, we still have to assess, but they are expecting a lower cost because of AI. So there's a pricing pressure on the company.
The other thing is your attrition stands at 5% for the quarter, and there are
Uh-huh.
multiple AI wins listed. Tell me,
Yeah.
how is talent and delivery capacity scaling for larger AI engagements? And would you be looking to up your headcount?
We are doing a lot of work on training our people, several programs internally because everybody has to be on the mindset of AI. It's not just the models, even the users have to think differently and function differently. So that transition is still happening. It's a little slow because it's a culture change, it's a mindset change, but that's beginning to happen. I don't think we will have a high recruitment program, given that a lot of stuff is now moving towards AI. So our net headcount increase will be lower. Of course, as we grow, there's a net increase, but not proportionate to the revenue because a lot of it will be offset by AI.
Doing a lot of work in insurance underwriting, and if I'm not wrong, SBI Life is one of the clients that you have. How's that scaling up, and when do you see that impact coming into your P&L?
That's scaling up. So we are in dialogue with every large insurance company in India and a couple in the US as well. That's really looking very promising to us. And we are expanding that platform from underwriting to claims and also doing underwriting for PNC. So the platform will increase, but the traction there is very good. And I'm very confident that we will win a few more projects very soon.
And are you in touch with large clients or consolidation processes which are happening in the market? And from that point of view, are you seeing the decision making getting little delayed, given the kind of global geopolitics, political headwinds which are there?
We are seeing a little softness in the market, that is correct. However, on the back of AI, we are seeing the cycle time reduce. So the typical time would be 9 to 10 months on an average. That has come down by about 2 3 months. So the cycle time for decision making is lower, but general softness is still there because of the global uncertainties and the war that keeps going on and off all the time.
Project size is now much more smaller. It's more pilot in nature, and once the pilot is successful, it is then that it goes to the execution stage. Are you get the size of the deals are they shorter and short duration and short value as well?
Actually, to the contrary. So we are seeing so pilots are still small, but after the pilot is done, the projects are larger. So we are seeing a uplift in the project size. Having said that, they are more project versus an annuity. So they're not like a 5 year program. What would be done in 3 years now gets done in 6 months, let's say, right? So it's a project oriented thing, larger deal sizes, but project oriented versus annuity. And certainly pilots are still there for 30, 40, $50,000 pilots, but once successful, then they translate into larger projects. And the deal sizes fundamentally we see increasing.
And what would be the kind of total order book at this point in time for you?
So we need to compute because a lot of this is transaction based, outcome based, and that depends on the volumes that the customer has versus earlier it was more time and material where you could just have 100 people working on a project. Now it depends not on 100 people but on the volumes that the customer gives. So that's a little sort of tricky since we are moving to an outcome based model largely. We got to recalculate the whole order book. So I think we are in the process of recomputing all of that, and we'll have a number sometime in the next quarter.
Need to
But
recalibration of the.
it's looking very positive, and I think we will hit our growth numbers of high single digits.
Right. Rahul, great to have you today on ET Now. Thank you so much for your time.